after Java told us everything about valuation, I'm going to talk about velocity, centralization, and incentives. So it's going to be a bit more theoretical, but there's going to be as well some data analytics, especially at the beginning. So let's first introduce myself. I'm a senior research fellow at DSF, also member of the UZH Blockchain Center. I was in Zurich doing my postdoc. Previously, I did a PhD in quantitative finance in Pisa and all the master in physics before that. And you will see some part, some of the physics inspiration in here as well. What I'm going to talk about today. So first of all, I'm going to start with a brief introduction to my research, looking at understanding centralization in DLT economies. And I'm going to talk about the MicroVelocity framework, which is something that we developed in Zurich, and about transaction networks as well, and the analysis of transaction networks. And then I'm going to take a step back and look at the causes that are behind the results that I'm going to show in the first part, which is the economics of decentralization. So in particular, I'm going to talk about economies of scale, civil protection, where is the value of tokens, token allocation models, and complex tokenomics models, and how they can turn out. Right, so let's start talking about microvelocity, and in particular talking about velocity of money. So velocity of money is a macroeconomic concept. It's 100 years old, even more. It's often introduced alongside the quantity theory of money. And it's the frequency with which units of money are exchanged for goods and services in a given economy in a given period of time. So the key equation in here is MV equal PQ, and what does that mean? On the left-hand side, you have the money supply and the velocity of money. Money supply is basically the amount of money that is going around in the economy. And on the right-hand side, you have the price level, so the average unit price of goods, and the Q, the real economic output, so the number of units of goods that are produced and exchanged in an economy. And when you talk about, I mean, it's very, you hear a lot about inflation right now. The P here is what is growing when you have inflation, basically, right? So you can have two sources of inflations. That's basically the idea. You can have a money supply increasing or velocity increasing, and those can be two sources of inflation. Right, so what is velocity at the heart of it? An economy is a living thing, it's made of living beings, humans, and the velocity is kind of like its temperature. It's like you may have a fever, you may be a bit too cold, and you don't want either of those. You just want to be right there. So you don't want it to be too cold, you don't want an economy to be still, you don't want to have too low velocity, because a low velocity economy is a dead economy. You also don't want it to be too hot. An economy that goes too fast, where you get rid of your money as soon as you get it, is perhaps an economy that doesn't really trust the value of its money, and you may have hyperinflation problems. And just to make a reference to my physics background, this is an ideal gas where if you think of what the temperature is in a gas, it's actually the average velocity squared of the particles in that gas. And that's kind of like where this reference between velocity and temperature comes. So this is just an analogy. Okay, so why is velocity of money interesting for cryptos and for tokens? Right, so Java talked about valuation. I'm going to talk about valuation in one slide, because velocity of money is also used as a valuation tool. You can measure the velocity of a token. In particular, here is velocity of Bitcoin, looking at the exchanges of Bitcoin and seeing how many times Bitcoins are exchanged over a given period of time. And from there, you can go to the market capitalization, the implied market capitalization at least. Now, you may say, here I'm comparing the velocity implied valuation with the market capitalization, and you will say, oh, this is great. Velocity is a great signal for trading, you know? Except, just as Java was showing before, these are also a lagging indicator, so you can actually not trade on that based on that. This is following the market cap, it's not anticipating it. This is you probably don't see it very well, but the green line is the one that is shifted a bit to the right, and that's the velocity implied valuation. The blue line is the market cap. So actually not great for trading, so it's a lagging indicator. And there are also another couple of flaws that you have when you talk about velocity of money in the traditional sense. And in particular, First one is that is measured from macro data. So you have low resolution. Typically, you can measure this every now and then, not all the time. You also don't have any insight on the economic structure. You don't only measure an average, and the average is, you think it's representative for the whole economy, but actually that's typically not true. So that's where the last point comes from. You're not accounting for any heterogeneity in the economic agents that you have in your economy. That's where we jump in. So we talk about microvelocity, the microvelocity framework, which is literally triggered by the transparency of DLTs. So when you have a blockchain, when you have a DLT, you can actually read the transaction and track where the money is going and who is moving where, et cetera, et cetera. So you actually, instead of just looking at the velocity as the average frequency with which any coin in the economy is involved in a transaction, you can actually look at the average frequency with which each coin is involved in a transaction. And since you have full information, you can directly measure the frequencies. So this is the key idea at the foundations of this microvelocity framework. And just to give a toy example here, you have a toy blockchain where you have Alice, Bob, Dan, and so on, and they exchange some tokens. You have Alice receiving one token, Alice giving one token to Bob. Bob gives the same token to Emma a few blocks later. And so basically you can say that token has moved over those 2 blocks. And the same happens with the half token that Bob receives from Dan and gives to Flores later on. What is the maths behind it? I'm going to keep it very, very simple. Since you're measuring the velocity, I've talked about it being the average frequency of transactions. The frequency is an inverse of a time. So what is the time that is relevant in this case is the time between transactions of a coin. Let's call this tau, and let's measure all these taus for all the coins. We end up with having a distribution of these taus, P of tau, and then you can show that the velocity, the average velocity of money for all the coins in the economy is just this average of 1 over tau. So the inverse of the holding time is the frequency of transaction. You average it, you end up with the average velocity. Cool thing is that this can be disaggregated, because if you condition instead of on any coin, you can condition on ownership of coin. You know where a given coin is at any time on a blockchain. So now I can not only measure the average velocity of money, but I can measure the average velocity of Carlo. So my coins are going to have an average velocity of money, which is different from the average velocity of money that Java's coin had. And this is exactly what I'm showing here. So the average velocity on the left for my own coins is going to be like that. And the nice property is that it all sums together to the total velocity just by a weighted average. Okay, so how do you do this in practice? You look at a blockchain, and then if it's a UTXO blockchain, just like Bitcoin, so where whenever you spend any money, you are referencing directly a transaction where this money comes from, then the holding time, the time that those coins have stayed idle, is just the age of that UTXO, of that unspent transaction output. If instead you have an account-based blockchain, then you like Ethereum, then you don't really have this information. You just need to make an additional assumption. And in particular, what we did is using LIFO queuing, so last in, first out. So this is economically speaking sound, because you typically have a part of your money, which is your savings that you never touch, and then you have your disposable income that every month comes in and you spend right away. So that's the last in and first out that you have. Right, so let's look at some results just to move things a bit. And as again, I started saying this, we started doing this because we were interested in looking at the distributional aspects of these quantities, right? We want to see how these things changes from one user to another on a chain. So here you have these stacked areas that the total is the total velocity always, so it's constant, it's normalized, but the areas, the different areas are colored in a way that those are different agents in the economy, right? You have Litecoin, Monocoin, Dogecoin, and Feathercoin as 4 examples here. And the blue area at the bottom is everybody except the top 5 contributors to velocity. The green area at the top is the top contributor to velocity, and basically these are the top 5 1, 2, 3, 4, 5, and then everybody else. So as you know, there are like several 100,000 users or even millions of users on these chains, but actually most of the velocity is just contributed by very few of these users, right? And this also applies to Ether. So we looked at Ether as well, and this also applies there. In some periods, specifically in the ICO craze here, you see that this was a lot more distributed. The top 5 is not accounting for a very large fraction, still a very significant fraction, but not very large of the total velocity. But you still have quite an unequal distribution. And the cool thing that we could do on Ether as well is looking at who is behind these addresses, who is behind this these contributions to velocity, to moving the money around. And typically these are centralized exchanges. So the blue bars that you see here, sorry, I should explain first what the y-axis is. Y-axis is the percent of times that an address with a given labels provided by Etherscan appears in the top 10 contributors to the total velocity. Okay, so if you look at the left here, basically 55% of the times you have exchanges as top 10 contributors to the total velocity, and then moving on, this is any exchange. Then you have all different exchanges, you have Binance, Bitfinex, Kraken, and so on. Then you have contract minting and contract burning, token minting and burning contracts. And then you have DeFi protocols as well, somewhere around here. And then at the end, you have like some criminal activity and the Ethereum Foundation, actually. But overall, basically what we're seeing is that centralized exchanges are the ones that actually transact on blockchain most and move most of the funds on blockchains. You may ask, okay, how is this economy structured? I thought about the economies being transparent and blockchains being transparent. So actually you can not only look at who is moving money around, but you can actually look at what the relation between people moving money around is. And in particular, what we built is transaction networks. So you analyze this data by mapping the blockchain into networks where you have a node of the network being an address of the on chain, and then there is a link between two addresses if there is a transaction going from address A to address B on that given on a given time. In particular, here we're looking at weekly time frames. And for UTXO-based, so Bitcoin and that family of blockchains, you can also do address clustering, because of course addresses are generated continuously because of the UTXO protocol. So it can become very, very hard to make sense of the identities. There is a suite of algorithms that you can use to map single addresses into groups of addresses, and that you can call entities. These are basically your best guess for how an individual behaves on chain, on Bitcoin and similar platforms. Right. So how do these networks look like? Well, they look typically like any other economic network. Typically, these exhibit a core periphery structure. So what is a core periphery structure for a network? You have your nodes, and there are basically two classes of nodes. There are core nodes and peripheral nodes. The core nodes are very tightly connected together, and they are here at the center of the network. And then you have peripheral nodes, which have very sparse connection. They don't have a lot of connections, and they typically connect only to a core node or to very few core nodes. They don't connect between themselves. Okay, so this is the typical the typical structure of an economic network, and crypto networks are not very different from that. And actually, what is interesting to see is what is the size of this core, how small it is compared to the rest of the network. And here you have exactly that. So here you have the number of nodes that lie in the core of a network compared to the total number of nodes in that network. And you have the historical time series here. And you can see that basically for all of them, this fraction is relatively small. It goes basically from 1% to 1 in 10,000 and so on. And as you can see, actually, since you have the whole history, it's interesting to see how this is a declining line for most of them, right? And specifically for Bitcoin, but also for Ethereum, which is here, and yeah, Ethereum, which is here. So it's a declining line, right? So this means that the core is getting smaller and smaller compared to the total size of the network. The network is growing, right? But the fraction of nodes that lie at the core of it are less and less. And these are the nodes that, again, they are the ones that intermediate all the transactions, basically between one end of the network and the other. So you cannot send money to anybody. You typically pass through one of these. And there are many reasons for that we're going to look at in the more theoretical part of this lecture. Right, so the cool thing to see, as I was saying, is that if you look at Bitcoin, for instance, here, it started as very, very decentralized. Almost, basically, there is no distinction between a node that is in the core and a node that is in the periphery. It's very hard to distinct them, and basically that's 50-50 the share. After 1 year, it started declining, and that's when Bitcoin started to grow quite a lot, actually.
Sorry, I think
yes, please.
The question on the earlier part on velocity.
Yeah.
So, so higher velocity represents higher token value, like.
Oh, so more or less, in the sense that if you have a higher velocity, this implies that you have more activity on your network, right? So then, again, as I was saying at the beginning, too high velocity might be that actually it's the supply driven and not demand driven. Like you want demand driven velocity, you want people to want your token, you want people to want to accept your token in exchange for goods, and you don't want people to dump your token to other people. So that's something that happens when you have too high velocity. That's the hyperinflation scenario. So you don't, it's a kind of a sweet spot. Velocity, you can estimate it, and then together with volumes of transactions, then that's what leads to the valuation. Okay.
And also, like, obviously, some blockchains are much faster compared to some others. For example, like Sybil or Solana versus Ethereum. How do we account for that?
Yeah, sorry, I should have specified that. The velocity here is in block time. Sorry, I will repeat the question for the people online. There are different blockchains at different speed at which the different throughput, basically, of number of transactions that they can have. How does that affect the velocity estimation? It does up to a scaling factor, basically. So you just need to account for the fact that there is that throughput, and you can normalize for the throughput. So basically, you can normalize by the number of blocks that happen every minute or hour or day or whatever your time scale is, and then you can compare different velocities, basically. Right. So as I was saying about, I was talking about core periphery structures. We can also mix the two things. We can also look at, is the velocity that is so unequally distributed somewhat related to the network structure of the and to the core periphery structure? And the answer is yes, actually. So here you see the average, the ratio between the velocity in the core and outside the core, normalized by the number of nodes in the core versus outside the core. So this number is large. It's over 100 or even 10,000. So this is basically saying that the nodes in the core have a much higher velocity than the nodes outside the core. And this is kind of intuitive if you think about it, right? You have intermediaries at the core of the network, and these intermediaries churn a lot of tokens from a lot of people. They are typically your exchanges that you use for transferring coins. So, I mean, this is exactly the kind of behavior that you would expect. And this is the Ether plot for the same quantities. You see, after 2018, this has grown a lot. So this consolidation of throughput in the core of these networks is real. Right. So this just was a short introduction to these quantities that are interesting to look at least in my opinion, when you want to understand what is going on chain, and you want to figure out how centralized these networks, these transactions end up being, right? And how decentralized these economies are in truth. And then this is where I stop with my own research, and I start citing smarter people than me. And let's talk about the economics of centralization. So the economics of centralization start from a very simple effect. There is if you look at mining, for instance, now this Bitcoin mining in particular, but applies to any proof of work, you have had an evolution of how mining has evolved in time. And basically, you started from a very decentralized way of mining, which was one CPU, one vote, right? If you look at the gold rush, this is kind of the same as having miners, gold miners, going to a river with their own pan, trying their luck, and that's it. It's very inefficient, though, no? So actually, you want to specialize. Some people start specializing. Some people in the gold rush would buy their own equipment and start taking part of the river out of the river and doing this on a larger scale. This is exactly what people started doing with GPUs, right, for mining. And then, you know, you can build an enterprise and you build a company. You say, okay, I'm going to start my own mining company. I'm going to actually displace the whole course of a river just to have easier access to the gold that is that is there. And I'm going to have employees and so on. And this is kind of like the rise of specialized hardware that is has been built on purpose for these things. And then you end up having like very large, very consolidated corporations that run huge mines or huge ASIC farms, right? So this is kind of a nice analogy between gold mining and Bitcoin mining that has been proposed by these very smart people in their book. And it all points to one simple effect, which is economies of scale. So what are economies of scale? Economies of scale basically is the effect that few powerful validators, most in proof of work, but it also applies to proof of stake systems, are way more cost effective than many small validators. And this figure here shows you a very simple relation that applies in most economic systems. You have output, economic output on the x-axis, so the number of units that you produce, like number of blocks that you mine. And on the y-axis, you have the average cost of that unit of output. And the curve here, the curve, the concave curve here is your long-run average cost of that unit of output. So typically, where if you have very small outputs, the average cost of each unit of output is relatively large, and that's because you have fixed costs. Sometimes you have infrastructure, you have you need housing, you need whatever. No, you need to buy real estate to host or rent real estate to host your server farm. So these are costs that are impacting a lot your unit cost for output for per block that you mine. But the more you are able to produce output, the more you amortize these fixed costs, and so your average cost per unit output decreases. And in Bitcoin, like any other original, let's say, early blockchain, the average reward that you get per unit output is constant. So no matter if you mine 1 block or 10 blocks or 100 blocks or 1,000,000 blocks, the reward per block is always the same, right? So this is a problem in the sense that the difference between these two lines is the margin. So you're going to have that a miner that is able to produce Q2 blocks is going to make a lot higher margin than a miner that produces Q blocks, right? Actually, the Q guy is below the reward, so it is unsustainable. It cannot sustain his own mining. He's not going to make enough money. So you end up having that all the miners that are in this side of the output curve get kicked out of the market, and only the guys that are here at towards the minimum of this average cost curve are able to sustain their own efforts. And this is more or less what happens with pools. So you have companies within pools that associate themselves in pools to amortize the risk of not getting a block, but all of the people that is inside these pools, they are not your one CPU, one vote original Bitcoin miners. They are actual companies with very specialized rigs, and they are all at that bottom of that average cost of output curve. Notice that this applies also to staking, because typically staking rewards, again, you want to amortize risks, and you want to optimize hardware. So that also applies for staking. This is on the left-hand side here. Sorry, on the left-hand side here, you have the distribution of mining pools. So the power that mining pools in Bitcoin have, and on the right-hand side, you have the power, the validated power of staking pools in Ethereum, and they look remarkably similar. No, there is a very massive couple of pools that are able to mine most of the blocks, or validate most of the blocks. So first lesson learned from this theory and from the evidence that I showed at the beginning: beware of economies of scale. When you design a layer 1 token economy, where you need to preserve your consensus security, you walk the very thin line between a secure network and a fully distributed validating power. So economies of scale tell you that constant rewards lead to concentration of validating power, and diminishing rewards, although they may sound appealing in terms that they can solve the economies of scale problem, they may result in a lower total stake, because you're not going to attract high stake individuals, because they get diminishing rewards if they try to stake more than that, and then lower consensus security, as well as Sybil vulnerabilities. If you have diminishing rewards, so let's say that if I mine the first 5 blocks, I get a reward, and then if I mine the second 5 blocks, 5 to 10 blocks, I get half that reward, let's say. I have no incentive to mine more than 5, except if I open another account, set up another node, and mine 5 blocks here, 5 blocks there. That's a Sybil attack. Okay, so I'm flooding the network with multiple nodes that, and I'm getting rewarded for doing that. So diminishing rewards don't really solve this problem as well. And the key point is that decentralization is costly. So to run a permissionless consensus protocol, you need this sort of Sybil protection. This is exactly what this proof of work and proof of stake do. Again, a Sybil attack is when an attacker creates a large number of nodes and distributes false information to honest nodes. So you're flooding the network with bad information for your own sake. Maybe you want to double spend or whatever. And Sybil protection is the way of sending validated messages costly in some way, and that's proof of work or proof of stake, or proof of authority. So basically, allowing only authorized nodes to send these messages. So the problem of this Sybil protection is that you need to compensate validators to cover their costs, because again, they spend something, they pay something in order to be able to fulfill your Sybil protection requirements. The problem is that they typically pay costs in fiat money. Let's say you are a miner, you have to buy equipment, you have to maintain the equipment, you have to rent real estate, and so you have costs in fiat money, but there is no fiat money on chain, right? So there is only Bitcoin or whatever else. So you need exchanges and outside demand for tokens. So this is the key point. You need outside demand for tokens. You need people to want tokens so that you can sustain your own mining. Now, let's keep talking about Sybil costs for a moment. This is a paper that came out in 2019, and it's about the probability that you actually end up with an acceptable level of decentralization if you have constant Sybil protection costs and the Sybil protection rewards, and based on some parameters. So here you have your validation resources inequality. So if you go to the right of this, you have more inequality in the resources that are available to validators to validate their blocks. So let's say if you are to the right of this, you have one miner. Let's skip to the Bitcoin example. You have one miner that has 50% of the mining power, and everybody else has the remaining 50%. If you are to this side, and they say, let's say you have 10 miners, more or less everybody has more or less 10% of the mining power. And the probability of decentralization here is the probability that you end up in a situation, naturally, that where you have an acceptable level of inequality between validators. So then the reward that comes out of the system for the validators is acceptably unequal, in sense that you have a threshold, and the more you are tolerant with this, the higher the probability is. But basically, the result here is even simpler than that. If you see these numbers here, they're very small. So the probability of having an acceptable level of decentralization in these systems is very low, actually. Okay. And if you look at Bitcoin in particular, we plug numbers of Bitcoin in particular, you will be around here. And even if you accept that the top miner has 1,000 more times the rewards than the 15th percentile miner. So if you have 100 miners, you take top miner and the 15th miner in the ranking, the ratio is below 1,000 in terms of the block reward that they get. The probability is still less than 10%, the 1%. So this is why there are economic forces that drive you towards centralization. This is pretty bad if you're looking for a decentralized system, and this is always for validation, right? And a secondary effect of this, as I said, you need on-ramp and off-ramps for miners, for validators to pay their own costs, because they need to exchange this money. You end up with the situation that we had last year. This snapshot from last year, when FTX was still a thing, of the exchange volumes, and the large purple thing is Binance, and then you have Coinbase, FTX, and so on. And these are single points of failure. These are companies that can do misconduct, or they are subject to regulation at some point, maybe. And these are single points of failure for your system, right? And this is the more recent picture of the same kind of statistics. So this, and you see that, again, when Binance started to have in trouble with the SEC last March, this share has dropped a bit, and but still, it's very, very concentrated, right? So these are all forces that drive you towards centralization, and are problematic when you decide how to set up your tokenomic model. So the second lesson that we learn is that Sybil protection is a massive source of centralization. The consensus layer of a protocol requires you to have some form of Sybil protection, because otherwise anybody can post any sort of false information. They can double spend or whatever, so you cannot allow that. And there are two solutions to that. Either you have a permission network where Sybil protection is granted by the authority of pre-selected nodes. And this is what happens with Hedera, for instance, or with Corda-based protocols. And in this case, you don't have extra costs. Validators are cheap because they don't need to pay the cost of Sybil protection. They're basically endowed with the right, and that's it. Of course, this is a trade-off. You are allowing for centralization built-in centralization, right? You are saying, okay, there are only 30 or 50 nodes that are allowed to write on chain. If you have a permissionless system, on the other hand, where you have anybody could become a validator in principle, then you need this costly mechanism and an associated compensation for honest validators. And this, I want to stress, drains resources from the network, okay? This is a cost. This is why you have to pay gas fees. This is why you have to pay fees to Bitcoin miners. This is why you have to pay the fees on the networks. If you look at Hedera, for instance, the fees are very low, and that's because it's a permissionless network. You don't have to encourage validators to come in and expect very large rewards for their honest behavior. There are just a set of nodes, and they just need to cover their own running costs, which are very low if they don't have to do the Sybil protection, pay the Sybil protection cost. So this requires resources from the network, and these are drained from the value that is taken in from outside or produced on the network. Okay, so if you produce something on a blockchain that is permissionless, you're going to pay part of that as a fee to the validators, just to keep the system running and being honest. Okay, so moving on beyond consensus layer, we're going to move closer to what Java was talking about earlier on. we're going to look at layer 2 tokens and how their tokenomics is designed. So first of all, some motivation. Layer 2 tokens have proliferated. You see, this is the number of cryptocurrencies, and most of them are layer 2 tokens. Most of them are Ethereum-based tokens, actually. Although they also died over the years. And so here you can see a bunch of the reasons why, but most of the time is because they had bad tokenomics. So this is the number of abandoned coins with no volume whatsoever in terms of transactions. Okay, and that's mostly because they had bad tokenomic models behind them. So this is also a cautionary tale, right? Then there are, of course, there are the scams, but let's not count them. The most important thing is that most of them just get abandoned because nobody is interested anymore. So the question there is that you need to ask yourself if you have to design a tokenomic model is, where is the value on your layer 2 token? And depending on the value proposition, your model will change. So this is just a few examples of what the value proposition of your token could be. It may be a governance token, it may be a utility token, it may be a security token. They don't suggest that. It may be an NFT, or you just may have the wrong design. So it may have no actual value. So I'm gonna try to interact a little bit and ask you a question. When do you think the concept of token was invented? Okay, I wouldn't go that far back, but that's a good answer. And I'm thinking of the Dutch East India Company. So it's the first joint stock company in history from 1602. Okay, and why am I saying this is where I trace the concept of token? Because stocks in the end are securities, and there are security and governance tokens. Okay, that give shareholders voting rights towards defining the company's strategy. They give them a share of the revenues when they pay dividends, and so on and so forth, right? The key point is that they are stupid tokens, though. Okay, they're not programmable. This is the big advantage that you have with DLTs. Tokens that you create on DLTs are programmable. Don't try to make a token that does not benefit from this. If you just want a token that is about giving shareholders voting rights, just make a stock. Okay. If you want to have something that actually lives on a blockchain and makes sense there, make sure that you exploit all the advantages that are on the blockchain. And blockchains have the advantage of having smart contracts or having programmable money, programmable tokens. Okay. So let's talk a bit about what governance tokens are. I mentioned there are few kinds of tokens that you may have, and let's try to look at what their value proposition is. For governance tokens, the value proposition is putting an incentive to participating in a new blockchain application. Okay, particularly for DeFi, but not only. So you delegate, as the token creator, the founder of the protocol, whatever, you delegate some of the decision making to token holders. Okay, and generally speaking, you try to make sure that by design, whatever the governance token allows people to decide on align with the development of the protocol. You just don't want people to come in and exploit the decision-making power and take all the value outside of your protocol and just leave them. They can typically be traded. This is a nice perk of it. They are very liquid in some cases, right? You can just, okay, I'm interested in taking that coin for voting for something, and then 1 year later, I just figure out, okay, I'm not interested in this. I'm going to sell it, and somebody else will pick it up. You can earn them by participating in the protocol development, right? So they can be distributed, and typically they are distributed to the stakeholders when they raise funding in the initial stages of the protocol development, but also to the team that develops the protocol. And again, there is an objective to have a balance between decentralization to a wide group, but you also don't want to have a lot of people that just comes in and lives and have no affiliation to the protocol. They have real incentive to make good decision making. So you actually want to try and reward consistent participation in your governance process. So just to give a couple of examples, you have all these protocols that have governance tokens that have that are associated to them and that are somewhat involved in the decision making, the internal decision making of that development of protocols. Then your tokens may have value because they are utility tokens. So you can actually use some services or access at the app or pay for some service by you having or spending the token. So you can have you can access utility through holding. So if you just are holding the token, then you can use the application while you're holding it. You have access to something, or by lockup. So in order to be able to access a given application, you have to lock up your token. You have to stake it in a vault for a given amount of time, and then for that amount of time, you're able to use whatever services, or through burning. That's actually a very common kind of utility token. You burn the token, or you spend it and give it back to the treasury of the protocol when you use the application. Sometimes they call them commodity tokens, mostly refer to the fact that Ethereum is believed to be a commodity and not a security, and that's because you pay gas fees with it, right? So when you pay gas fees with Ether, that's utility. And again, this applies to several kinds of utility tokens. So you may have BNB token that you can use to pay fees on Binance, or the Uni or the Curve tokens as well that allow you to farm liquidity, or the HBAR token that allows you to pay fees on the Hedera and the Hedera hash graph. Security tokens. We started with stocks. Stocks are securities. Security tokens are tokens that give ownership rights over a cash stream produced by the protocol. They satisfy the Howey test. Okay, so they are an investment of money. There is some sort of common enterprise, and there is an expectation of profit through the effort of others, to the effort of somebody that is working for you. Are and will increasingly be subject to regulator scrutiny. So in this, they're very similar to stocks, of course. I'm not going to give an example about this. Okay, and then there are completely useless tokens. Okay, completely useless tokens, as we've seen, there have been quite a lot of them, right? So if you have a great business idea, not necessarily it's a tokenizable idea. Okay, so creating a token economy makes sense, in my opinion, at least when there are these three conditions. There is value creation shared by many parties, and there are positive network effects. So you don't necessarily benefit from the product itself, but from the fact that the product is shared between many parties, or the production effort is shared between many parties. And crucially, other people can integrate your token in their own economy. You want people to use your token. You want people to make business with your token, right? You don't want your token to just sit there and just be, in that case, it would live way better on your own server, and you wouldn't pay the gas fees, right? So know what your value what value your token represents. One token fits all is a very bad proposition. I've heard this sometimes, where you say, I'm going to have a token associated to my business. Okay, what is the value proposition associated with that token? Make sure that there is a clear value stream and there is a clear audience that you appeal to. And tokens can have multiple functionalities. I'm not saying that they should have only one functionality. The advantage is also the fact that they can take multiple roles, but be wary of what prevailing interests you may have if you set up your tokenomic model in a given way or another. Make sure that the incentives are placed in a way that the multiple functionalities are preserved. Token allocation. There are several options with which you can allocate your token within the economy and take it to market. There is, of course, the ICO or IDO, initial coin offering, where you have a foundation or a company that raises funds, selling the token, and then these funds are used to develop the protocol and the token ecosystem. Then you may have mining, just like for layer ones, you have mining or staking, no? So new tokens are minted, and they're used to reward users that do work for the ecosystem. Okay, and this may be again layer one validators, but not only. Uni tokens are minted to reward liquidity providers, or will be actually. Curve tokens are minted to reward liquidity providers, or DAO voters. Okay, so mining and staking is also an option for you. Pre-allocation. Pre-allocation is actually very important in terms of protocol development on top of layer 2 in particular, but Ethereum as well did pre-allocation, did pre-mining. So tokens are minted and distributed to arbitrary individuals. You don't have, you don't let them directly on the open market. And these individuals may be the developers of the protocol, early backers, founders. Okay, there might be an associated vesting schedule. And when you look at these protocols when they launch, when you try to evaluate the tokenomics of a protocol that is launching, see if there is a vesting schedule, and I'm going to get to that. Finally, there is also the airdrop mechanism, of course, which is good to raise awareness about your protocol being launched. Tokens are minted and are distributed for free to whoever signs up. Sometimes you can also have bounties associated. So maybe you have a base level that is airdrop, but then if you do some very simple tasks like sharing a post on Twitter or whatever, or participating to discussions on Discord, then you can get extra tokens. Fun story about this, and this is where I'm getting to with the pre-allocation thing. A fun story, and there's this Medium article by a former employee of Consensus, Faiz Khan, and this article is about Coinbase curse. Now, without getting too much into the details, but I'm going to show you a couple of spreadsheets. These spreadsheets are basically the returns of tokens that have been listed on Coinbase between 2018 and 2021 compared to the US dollar. So if you look at the returns measured with in dollars, so if the price was 10 and then it's 100, the return is 10 times. Or denominated in Bitcoin or Ethereum. So instead of looking at the comparison between the price in dollars, I'm going to look at the price in Bitcoin. Okay, so this discounts the market effect if I look at the price in Bitcoin or Ethereum, because if I'm basically saying if the price of Bitcoin has grown by, let's say, 30%, and my token has grown by less than 30%, then I'm going to be in the red. Okay, so the fun fact here is that, okay, this was a massive growth period for crypto, right, between 2018 and 2021. So every token that was listed on Coinbase in those years appreciated, okay, by 1,000% or at least 37% in 2021. Although if you denominate it in Bitcoin or Ethereum, you are mostly in the red for all the tokens that are older than 1 year. This was this guy did the analysis in 2022. So when they were listed in 2021, they were 1 year old on Coinbase, 2020 they're 2 year old, and so on. So any token that is more than 1 year old basically was losing money when denominated in Bitcoin or Ether. The percent of tokens that were underperforming, depending on how long they've been listed, was pretty high, especially for the ones that have been listed for at least 6 months. Most of them were underperforming compared to Bitcoin or Ether. And interestingly enough, Coinbase until 2020 was publishing a list of tokens that it was considering for listing, and then decide which they're going to list or not. Okay, and the ones that the Coinbase ended up not listing consistently overperformed Bitcoin and even Ethereum for the one that went 2020. Okay, so actually this is a fun story, because there is, if you're interested, read the post. It's there is a lot more there, but basically it's building a case for the fact that these tokens that underperformed were being dumped on the market by the early backers, that the guys that were pre-allocated the funds as soon as they were listed on an exchange. They would dump the tokens to the market and basically leave with the money and the dumping on retail. So, fourth lesson, token allocation can go wrong. And if you do excessive pre-allocation, As soon as the token becomes tradable, that may crash your token price, because your early backers or your developers, they may leave and just say, okay, I want to cash out. Some other facts: excess minting without proper backing of value. So if you mint tokens, but you're not actually increasing the value of your protocol by increasing traffic, increasing the product that you're offering, will devalue your token. This is simple supply and demand law. And beware of insider trading. This was just the last example, the funny story that I told. Beware of insider trading. Longer vesting schedules are a safeguard against this. So that's why I was saying check for vesting schedules. Finally, I want to talk about the complexity of tokenomic models, because these things are getting out of hand. This curve, it's a schematic of how curve works, and the CRV token in particular. So curve is a liquidity pool, and it's an automated market maker. It has its own protocol there. And of course, if you provide liquidity, as Java was saying, you want to overcome impermanent loss, so you want to get rewarded somehow. And so if I'm a liquidity provider and I post some tokens to the liquidity pool, I'm going to get the liquidity provider tokens, and that's normal. But I'm also going to get some CRV tokens, and the CRV tokens, I can either sell them or do whatever with them, but I can also lock them for voting is crowd CRV. So this VE CRV, okay? And depending on the amount of time that what is the name again? Lock them. Depending on the amount of time that I lock them into the vault, I'm going to get a different number of VE CRV for every CRV that I lock. So the longer the period, the more VE CRV I get. The maximum is 4 years. The minimum is even less than 1 year, actually. So what can I do with VE CRV? I can boost my rewards as a liquidity pool. So I can basically begin minting CRV tokens and increase my incentive to stay in the system. But most importantly, I can change the gauge weight, vote on the gauge weight. So this is the law. This is why this is a governance token. This is the law that dictates how fees are distributed between pools. So I can say there is a higher fee on a given pool that I'm staking to than posting liquidity to, okay? And I can push that in a way that I maximize my rewards because I'm staking to the right, I'm posting liquidity to the right pool, providing liquidity to the right pool, okay? So it's starting to get complex, right? It's starting to get complicated. And typically when things get complicated, they can even become more complicated when you add another protocol on top of that. And that's the yield farming protocol Convex. Convex is specifically built for Curve in a way that is made to maximize the output, maximize the rewards for convex stakers. Okay, so this is getting very complicated and very complex, not convex. And I'm not going to go into the details, but as you can see, there is quite a lot of arrows in here, right? And depending whether you are a Curve liquidity pool token holder or a staker of Curve, the whole value proposition changes. But basically, what is the key point here is that, yes, you may have a more complicated, more complex tokenomic model to extract new value streams. For instance, Curve was doing that because they wanted to have liquidity providers being able to tune what the rewards were in their own liquidity pools. But beware of smarter people. Beware of the fact that whatever complexity you put in your tokenomics model, that might be a door for exploit. Okay, that might be a doorway for exploit. Now, if you have some exploitable mechanism, smart people will find that at some point. Okay, and like Convex is not necessarily bad. I mean, it's doing it's making the system more efficient, actually. Okay, at least until we see a crash or something. I don't know. I have no position on that. That may be completely beneficial to the protocol, but sometimes exploits expose just an inadequate model, and think of Terra. Okay? The Terra-Luna pair, that was an inadequate tokenomic model, unsustainable, and it was very complex, so it took time to, fairly complex at least, it took time for someone to actually build enough power to kill it down, but they eventually were able to do that. So with this, I will conclude. Hopefully, among all this, you learned something. We learned something about tokenomics, and in particular, for bewaring of economies of scale, knowing that civil protection is a massive source of centralization, and in terms of design, know what value your token represents and the ways in which token allocation may go wrong, and also the fact that model complexity extracts new value stream, but beware of smarter people. With that, I'm going to leave you with some food for thought, and happy to discuss this if you want, or for the people online to keep discussing online. How should we solve the permissionless civil protection problem? This is, I think, a very big question, and so far not very much answered. And how do we make sure that value is created in Web3 projects rather than just moved around from one DeFi protocol to another, which is also a bit of a problem.